Hi YouTube friends. So I'm about to make a video that I have been somewhat avoiding over the years making. It's a little bit of a controversial subject when it comes to personal finance. In fact, I know it's going to maybe go counter to what some have been told either by financial advisors or others in videos. I know Dave Ramsey, if you're kind of a Christian-based finance management person, kind of goes counter to what maybe he recommends. But I want to tell you why I have chosen to resist the temptation of paying off a mortgage early. And I say resist the temptation because, listen, there is something extremely psychologically satisfying in being debt free. No doubt about it. I have thought about this numerous times, but I have very good financial reasons for choosing not to be debt free. And I'm going to explain that now. So, I've been in my house for roughly 20 years. And about 12 years ago, I decided to refinance my house, take a lot of the equity out, and finance it at a lower rate. And the rate that I got was a 4%-ish rate financed over 30 years. And what I did is I took the money that I had previously had in equity in my home, and when foreclosures started coming up on the housing market in the 2009, 10, 11 time frame, I started buying homes for rental properties. And I was buying these out of foreclosure, so they weren't in the best condition, but nonetheless, I was able to do a lot of the work myself. So financially, it made sense. Now, one would argue, why in the world would you take on more debt in order to use that money to buy something else? Well, if you think about opportunity cost, and most of my higher education is in the area of economics, and in the field of economics, this concept of opportunity cost is just literally beat into our brains. And opportunity cost, and I've got another video on that if you're interested in watching it. But in short, it is just simply the cost of lost opportunity on money. So it's money that you wouldn't be making if you could get a higher return on that money somewhere else. So as I said, my mortgage is at a 4% rate. And I just sold one of my rental houses. And so I did all the in and out calculations, all the money I put down to buy it, all the money I paid to fix it up, whatever financing charges that I had in there, the cash flows of rents coming back over the years, and then the sell price, the depreciation effect, and the taxes that I'm going to have to pay on the capital gains. And after all of that has worked its way out, I calculate an internal rate of return of 14.68%. So meaning I've gotten on the money that I would have used to pay my mortgage on my primary residence off with, I've gotten roughly a 14.7% return on that investment of that money. So for every dollar that I borrowed on my mortgage, I'm paying $1.04 back annually. But for every dollar that I don't pay back on my mortgage, I'm making $1.14 on. So the net effect is a dime on every dollar that I have borrowed on my mortgage for the length of my term now. So roughly 12 years. Not bad. I mean, I will certainly take a 14% annualized rate of return on money all day long. It's hard to get that in the stock market, certainly. But even the stock portfolio that I have is made up of largely dividend stocks. I've got a couple of stocks that are not dividend paying, but of my dividend paying stocks, I get an average rate of return of a dividend yield of about 7.5%, 8%. So as you can see, 7.5%, say conservatively, minus the 4% the money's costing me, is I'm still making 3.5 cents on every dollar that I keep for myself. So I'm actually making money on the debt that I have against my home, and that's worked out quite well for me. The other thing that I would tell you about that is that having cash available. I mean, if you're spending every dollar you've got, every additional dollar you've got on paying down a mortgage, let's say your air conditioning system goes out. Well, if your air conditioning system goes out, the HVAC company isn't going to take the equity in your home as payment. They want cash. Let's say you need a new transmission in your car or truck. Again, they want cash. They're not concerned about the equity that you have in your house. You might have your house completely paid for and have no money to do anything else with. So you just got to keep those things in mind. Now, you could borrow against the equity in your house, but then it's a loan, right? Worse yet, people put these charges on their credit cards and then end up paying 18, 19% interest on the money. So my point here is you need to do what's right for you. I'm very disciplined when it comes to finances. If I want to use money for investment, I use it for investment. I don't go out and buy new televisions or new clothes or go out and eat or buy new cars. I have always been able to save money pretty well and have been very disciplined with my investments. If you're not that type of person, this might not work out well for you. But it has worked out well for me. So I just want you to know that sometimes paying off a mortgage isn't necessarily the wisest financial move from a wealth building standpoint. And I've sort of considered my personal finances kind of like I would run a business. I mean, it's always been about trying to increase the value of the investment. So that's the story I wanted to share with you, give you something to think about, and as always, decide for yourself, informed.